through your mind. This feeling's got me on fire. Don't ever leave it all behind. Can you feel the attraction? Feel the attraction. Can you feel it between us? This energy's inside us like electricity. Feel the love running through like electricity. Feel the love.
Walking alone, the streets are empty. The only thing I can see is my own silhouette. I'm getting stronger, step by step. The clock is ticking, but there's no time for regrets. I've been flying from town to town, from London to Taiwan. I've been all around the globe, trying to protect your soul. We are heroes tonight. We will fly above the sky. We are heroes tonight. Yeah. We are heroes tonight. We will fly above the sky. We are heroes tonight. Show any fear. I've been flying from town to town, from London to Taiwan. I've been all around the globe, trying to protect your soul. We are heroes tonight. We will fly above the sky. We are heroes tonight. Town to town, from London to Taiwan. I've been all around the globe, trying to protect your soul.
I fell and lost to the war, shot me dead. I was lost and sad to the voices in my head. I gotta get up again. I gotta get up to another day. I'm not giving up again. I gotta get up. I gotta get up. I gotta get up again. I gotta get up to another day. I'm not giving up again. I gotta get up. I gotta get up. I gotta get up Look into my eyes. My heart beats like a drum. You listen to my lies. Love is far to come. Your love is far. Running at the speed of light, kissing every city lights. Calls me in this morning time, but it just goes on. Running at the speed of light, kissing every city lights. Calls me in this morning time, but it just goes on. Gotta get up again. I gotta get up to another day. I'm not giving up again. I gotta get up. I gotta get up. I gotta get Gonna get up I'm crawling around, searching for higher ground. Can't see in front of me, my enemies have tried every possible.
What's up, traders? How are we doing this fine Sunday? Welcome, welcome, welcome. Please grab a seat, sit down. The show is about to begin. Welcome, Jay Licious. You were first again. Who do we got in chat today? Everybody say hello. How are we doing? Today we have a very special guest for Trader Spotlight interview. His name on Twitter is Special Situations, or Jay. please hit him up with the follow. He managed $2 billion in capital at Goldman. He's focused on growth equities, fundamental value with a catalyst, volatility, and so much more. Alrighty. So please welcome. Everybody jump in the room. What's going on? It's Don. How you doing today? Who's ready to bank on Monday and throughout the week this week? I'm very excited. I've got a bit of a new strategy I'm trying this week. Thank you, Jay Licious. Just let me pull up one thing here on my phone really quick, and we will get into it. Alrighty. Everybody catch Shib today? Bang. Let's jump into it, guys. I'm going to go ahead and pause the music there. I'm going to start up some background music right here. There we go. Actually, I think this is copyrighted. 1 second. Here we are. Perfect. All right, guys. Without further ado, I'm going to bring on Special. Let me get him on the phone, and we shall begin. My man, Jay. Hello, hello.
Hey, 100. How are you?
I'm good, man. How are you? Can you hear me okay?
Sorry, just got my headset in.
Oh, yeah, we're good, we're good. Am I coming through?
Yeah, absolutely.
Perfect. Just want to...
Good to be here, man. Thanks for organizing.
Yeah, absolutely, man. Of course. Just going to say thank you for coming on the show. I truly appreciate it. I think we're close to 40 guests on the show now, which is pretty cool.
Awesome.
But yeah, thanks for coming on. How was your week this week trading, and are you having a good weekend?
Yeah, wonderful week trading. Same with the weekend. I don't think I've been in a period like this over the last 18 months where there's literally a trade to do in almost every asset class. There's so much capital in the system, and things are moving so quickly. You almost need a team of 10 people to capture everything. Right.
Which makes it just super, super exciting, right?
Exactly. Yeah, so last week we had trades all over the gamut, right? So my background is a fundamental background. So I was a portfolio manager. I traded merger arbitrage, convertible bonds, and distressed debt. And I can kind of go through those briefly. But the fundamental perspective, I have my core portfolio in fundamental names like REITs trading at big discounts to net asset value. I have, I bought energy names when I saw the deficit and the lack of increase in rig counts in the natural gas space. I have spin-offs like Victoria's Secret, which has been a compounder. I have growth names like Upstart, Seva, portfolio that has multiple factor exposures. And I've been able to get comfortable with that because of the time over the past 15 years I've been doing research. So fundamental investors tend to look at a company from 3 different lenses. So one is a company covered by net asset value, whether it's property or IP or the present value of contracts. Two, what is the future value of the company's free cash flows discounted to the present, using a risk-adjusted discount rate. And then three, on a multiples basis, how does this company compare to its peers? If this company does 100 million in revenue and trades at 500 million, and its peers have 100 million revenue but trade at $1 billion, what is the difference? Should the cheaper name trade higher, or is there a reason why it trades at a discount? That's kind of a very simple way to conceptualize the framework. And within that, there are a number of really interesting areas, like special situations. You can find companies particularly that are selling below their sum of the parts. They might have 3 or 4 businesses, and if you value each business, it might trade at a discount to the whole. The business might trade at a discount to its cash on its balance sheet.
Okay.
You might have companies that have multiple classes of shares. So you have companies that have maybe 2 or 3 different classes of shares, A, B, C, where one class has more voting rights, but you can arbitrage the difference in the values of the shares. Um, but just going back to, I guess we'll touch on first my background, then last week.
Yes.
You know, so I spent, a few years out of school in private equity, and I realized very soon that private equity investors lever companies with huge amounts of debt without doing downside risk analysis, and quickly after that went into distressed debt. And what distressed debt is, when you find a company that has performed, it's usually cyclical businesses, but also companies in secular decline, like Hertz, for example.
Okay.
You probably looked at the ticker HTZZ.
Yep.
When companies go through bankruptcy, it is one, either providing them capital to emerge from bankruptcy with a better capital structure, allowing them to reject leases, cut employee count, find new revenue streams, shed old debt. So it's taking either providing them new money or buying their debt and converting that into equity and then taking control of the company, or three, helping transform that business or selling it to another business and changing the management team. So did that, and it forced me to really dig into legal analysis and how to really dig into companies' capital structure.
Right.
From there, I went, after the market started to rally, after the tech bubble, I went into merger arbitrage, because a lot of businesses were acquiring other businesses. And, at that time period, Goldman had a group within the firm. They used to have something called proprietary trading before the Volcker rule, where the bank could trade its own balance sheet. And that's kind of where Dinakar Singh, who started TPG Axon, came from. Daniel Ock, who started OXIF, came from. Eric Mindich, his fund is no longer around, but he had started a $20 billion fund after his stint there. That fund was, the purpose of my work was 100% equities, and what I was doing was trying to find companies that are being bought out, and then buying them at a discount to their takeout value, and shorting the acquirer and locking that spread. That is called merger arbitrage. And if it's a stock for stock deal, if you're buying 10 million of the target, you short 10 million of the acquirer to hedge out the industry risk, and you can make a spread and lever it up. So that industry, you could have done 20-30% with very much lower risk than the market, and that lasted for a few years. In the financial crisis, the great financial crisis, we had a view that because I was in the banking sector, that Lehman Brothers, Deutsche Bank, Merrill, and others were extremely over-levered. It wasn't just Burry. There were hundreds of guys who knew about this, who had huge balance sheets, were levered 40 times, had toxic debt on their balance sheets in the form of CDO squared, where you essentially have a bunch of crap bonds that were wrapped in a paper with a waterfall, and then those bonds, pieces of those bonds are then wrapped in another bond. So you really don't even know what's in the bond of a bond. And we started shorting the crap out of that, and it went back to distressed. So that was those are probably the best years of my career.
Wow.
And we bought GGP with Ackman. So GGP was really interesting, and it goes to a trade I did very recently, which I'll touch on in a second. Mm-hmm. So I did another trade over the pandemic called Digital Bridge, but I got the idea from what we did with GGP. So with GGP, which is now owned by Brookfield, you essentially had a retail mall owner that had holdco debt. This is why as an equity holder it's important to understand debt as well, especially in times of market stress.
Right.
So it had operating debt, just like a mortgage. So if you have a mortgage for your home, that mortgage has a lien on your property, right? So that is usually operating level type debt. It's right at the asset level, okay? But most of General Growth Properties, its debt was at the holding company level, which means that the debt was at the box where the stock was issued, is the easy way to understand that. So that debt at the holding company level had no recourse to the assets of the company, which is how most investment grade debt is set up. So if you understand how to read credit agreements and bond indentures, that debt, you realize they could default on that debt. That debt could go to zero, but the assets would still be operating. So what we did was we essentially bought, so that essentially would allow the loans that were backed by the debt to perform. So we bought those loans at 30 cents. Those were triples. And then we bought the bonds because by defaulting on the bonds, we converted those bonds to new equity. Essentially, you could essentially convert those to new equity, bought those bonds, and we bought the stock because we thought the stock would still be around, given that after defaulting on the holding company debt, there would be enough cash flow, because you would save all that money on interest, there'd be enough cash flow from the operating assets to pay the equity in the future. So that equity was over 100x return. And that kind of set me up for the next opportunity. So essentially set up a fund with a couple friends to do convertible arbitrage. So I was doing convertible arbitrage, and it was a carve out of a large outfit. It was a multi-manager, but we had put in our own capital, and that was during a period of time where we were emerging from the credit crisis, and buying regular bonds, like high yield, wasn't really that sexy. Right, you're kind of like today, bonds are at 4%, then they're at 6%, and we're like, oh, that's not very interesting.
Right.
There's not a lot of distress, so we started doing convert arb, which is essentially like Tesla has converts. To provide an example, it's when you have a bond with a call option attached, and you delta hedge it. While that was happening, there's a lot going on in the market. There, like we're seeing in SPACs today, there are a lot of kind of lower risk arbitrage opportunity in the REIT conversion and MLP conversion market. That's how I got very close to the REIT market, which there are actually a lot of interesting opportunities, especially during the pandemic, which I'll get to in a second. But the government had allowed REITs to not pay, REITs not to pay taxes, but they have to dividend 90% of their REIT income. And a lot of companies that were not essentially real estate companies per se, but had real property like billboards, right, digital billboards, were converting into REITs, and their multiples were going up because all of a sudden they didn't have to pay taxes. Imagine you have a company that trades at 10 times earnings, it does $1 billion of earnings, so it trades at $10 billion. Now that company has to pay no taxes effectively, right? So its earnings go to 1.3 billion, it's now worth $13 billion. So we're finding all these opportunities where companies were announcing PLRs with the regulator to convert into REITs. And the same thing was happening with MLPs, slightly different, but with essentially gas pipelines. And that was our next play, which led us into kind of the 2015, 2016 sell-off, which is when I actually started my own company, a digital media company that I sold to the Rockefeller family, Venrock's the venture capital arm, focused on ETFs, because I thought that the retail investor was going to allocate into low-fee products. There are too many hedge fund managers that weren't generating enough alpha. So after I sold that business, I created a family office, and I managed my own wealth for a couple select accounts, like a couple small local city pensions, and some high net worth investors. And I did really well during the pandemic, and then in 2021 I decided, well, there's so many retail investors, right? We went from 17% of NYSE volume being, sourced from retail, now to 37%. They don't have any access to tools. So,
right.
My prior company, my goal was to help investors invest their 401ks, IRAs in very long-term, low-fee products that over time, right? The S&P has beat most mutual funds and most hedge funds. And, by paying very low fees, I was able to, our job was to find targeted funds that were the best for investors so they could compound their wealth quicker. But now, because there's so many opportunities for alpha, I want to do the same thing, but through investor education, by providing investors that, okay, you might have your 401k in the S&P 500 or the VOO, and some passive instruments or muni bonds if you're older and you don't want to pay, taxes on your bond portfolio. But a lot of guys now want to make alpha on their individual investments, right? They want to find really cool, special situations. They want to find, runners. They want to find, undervalued companies. They want to find growth tech that they can hold for 5-10 years and outperform the indices. So, my goal was to focus on that, because I saw that on FinTwit there's a lot of guys that just focus on one factor exposure. They'll do one thing, and when that thing blows up, you're kind of shit out of luck, right?
Yeah.
That might underperform for a year or two, and then everyone kind of, they post like, oh, I'm a never seller. Well, great, you're a never seller, but now your portfolio is down 50%. You're in Redfin, and Peloton and all these companies that have underperformed, and what are you going to do?
Right.
So my focus is asset allocation. Talk about how much cash I have. I find unique opportunities that are not really covered by Wall Street analysts or by FinTwit. Okay. And I've also started to focus on SPACs, because after the SPAC market sold off really hard, I waited for it to sell off before I started opportunities in warrants. There are a lot of companies with low float names. There are a lot of opportunities with companies that when they have a pipe, they sell off 25-30%, so there are opportunities on puts and shorts there. And there are opportunities in D-SPACs when you find companies that are cheap. And most importantly, there are NAV SPACs that trade close to 10, when there's enough interest, they trade at 10-15%. You could size positions in there, 10 million, 15 million, and if a name has no downside, right, you have a free call option. So think about it as parking cash. If that name's up 10%, you make 1.5 million. So that's kind of how I've set up. Hopefully that provides some background on me. I'm very focused on education and on downside risk management, and finding unique opportunities. So a couple of things that I've been involved with, maybe I can share via this screen.
Absolutely, yeah, let's do it.
So I'm going to share my Bloomberg here, and I'm also going to share some of the screeners I use. Okay, hopefully you can see it.
Yep, looks good. Yep, go ahead.
Okay, so this is the first company. This was called Colony Capital. So it's a company called Digital Bridge, which actually bought, let's see, go to 5-year. This is the example of the GGP-like company. So you can see you had 5 periods of time where you could have bought this, close to 170, 180 a share. And it was a company that was converting from, and my subscribers know this, it's converting from a hotel and office building REIT to a digital REIT that essentially owned data centers. And it was essentially run by a legacy management team that had been following for years, that had overinvested in New York real estate and industrial real estate and office real estate. Industrial has actually done well, by the way, in office real estate and hotels. And because of my experience in GGP, I identified that they could have defaulted on their hotel debt and their the debt backing their nursing homes, and use that cash flow they're generating from their portfolio to service their debt and essentially buy new assets in the digital space. So it was run by a guy named Mark Gonzi, who was a billionaire. As the CEO transferred to this new tech executive, and once I realized that, I started loading up in kind of mid-single digits, 150 to 180, because I knew that they could default on the debt, and now you had this new fresh CEO who could reallocate capital to digital REITs. And at that time, if you remember, the bandwidth required to do Zoom and to essentially operate digital companies at scale was going up dramatically, right? So while everyone was focused on Zoom and all these companies that, by the way, had already started to rally by the summer, you could have essentially thought, okay, well, where is Zoom going to get all its bandwidth? And they're going to get them from, and where are they going to store all their data, right? So essentially, this company is an infrastructure play on all, the real assets, right? Data storage facilities. These guys have 5G assets. They have, exposure to towers all over the world. And I started loading up, and this was a low-risk way, to make a 3-bagger. And not only that, I don't know if they are listed, but I'll show you something that I tend to focus on. They may not be listed anymore because they all went to par, but something that I focus on that is very unique, they're listed right here, is preferreds. So preferreds are equity-like instruments that are senior in the capital structure. So they're not debt, but they have debt-like payments. So these are 7 1/8, which is crazy preferreds. They pay a very high coupon, and during the pandemic, you could have bought them between 10 and 15 relatively easily with pretty size volume. You can look at the volume here. That a lot of that was me, and you could have bought this at 10. At 10, it was paying you a 14% over a 13% dividend, right? Because you're buying it at 10, you're getting paid 7.5 sorry, because the dividend was shut off. They're paying partial, but if you were to get the full dividend, right, on the 25, it was paying you a 28.5% current yield, assuming the dividend was going to be fully turned on after they defaulted on the holdco debt, and so you're making almost 30% a year, and you have potential to 2.5x, right? So I loaded up on securities across Digital Bridge, Redwood, a number of other REITs in the space. And that was, how I was able to, without any options and with low downside risk, size my portfolio in a way that I was comfortable, and generate like 600% returns, which is not normal, over the last 18 months without using any options or leverage or any crypto or anything, that has excessive beta. So, preferreds, I still look at preferreds. There's still some discounted preferreds in the market, and it's part of my differentiation. Because another name I wanted to touch on is Tiptree. So Tiptree was an insurance company, and this play just essentially played out in October in the third leg of the rally. So it was a company that was a sum of the parts play, and I build financial models. I'll show you an example of one in a second.
Yeah.
But Tiptree is an insurance company that no one was following on Wall Street, but you could see the flows, you could see the insider buying, and the executive team and the chairman of the board were buying stock in the company. This is an insurance business that actually also had a shipping business. It was owned by a guy that was trying to be like a Warren Buffett, but he acquired all the wrong businesses. He acquired an auto insurance business, trying to be like Geico at a time where auto insurance was very was very competitive. He bought shipping assets that he thought were cheap, and he bought property assets. And what I did was I did some analysis. I valued the real estate, valued the insurance company, I valued the shipping assets, and I realized, at a time where you could see, you could have bought this at $5 for over a year, and you can even go back. These are opportunities that, because they're not followed, you can load them, and because there's not a lot of social sentiment, you can load them up in huge size. So I was loading this up even before I was on social media, and once the market realized that its insurance company could potentially IPO, and by doing a comps analysis, you could find, where do insurance companies trade? They trade around 15 times earnings. They trade at a high multiple of book value. And if this insurance company were to trade at 1.2, 1.3 times book value, which was reasonable for its ROE, and it were to trade at 15 times earnings like its peers, it was a $15 stock. And the market didn't believe it right away, right?
Right.
It kind of popped, to 8. I trimmed about a third. It went back down to 7. I added back 15%. Then it rallied. I sold 20% again, always taking profits, right?
Yeah.
And then it had this big spike where I sold almost 75% of my position. So I had 25% of my position. Essentially what they decided to do was they thought that the insurance business was so valuable, it didn't even make sense for them to IPO it. Management wanted to keep it. But then there was no catalyst. It sold off again. I bought back half. And then they just announced that a large private equity firm was going to take out the insurance company anyway, because the management realized the stock wasn't going to move otherwise. So you could have made money here at 4 or 5 different times and loaded up in huge size, without any FOMO, without worrying that someone's going to pick it up, just by doing fundamental analysis. And that's kind of the beauty of looking at mid-cap stocks, where they're not as risky as small cap, micro cap stocks that have risks of like losing their listing, where you don't know if the management team's legit, the financials don't make any sense, they don't generate any cash flow. My bread and butter is kind of the mid-cap sector, but I also do look at Upstart. So because of my background in financials, I was buying Upstart almost from the 90s all the way up to the mid 90s down to the 80s, and understood that essentially Upstart is funded by hedge funds. So Upstart has 68% of its loan originated by one bank in New Jersey, but it's not the bank that they're getting all of their interest in. It's hedge funds buying consumer loans from this bank because they need yield. And that's, I don't think, what the street really understands. There's a huge demand for yield. And Upstart, their algorithm may or may not be the best algorithm. We won't know until the next credit crisis. but they're the best aggregator of credit. So if you run a dentist practice, right, you're not getting a W-2, and you might not be an easy underwrite, right, for a loan, believe it or not, even though you're running a successful dentist practice and you're bringing in, let's say, 150K, it's harder to underwrite you a loan than it is to underwrite, a truck driver who's making 70K but is W-2. So what these guys do is they take your location, they take in your education information, if you run your own business, your assets, and because they're, these smaller banks don't have enough loan officers and they're not sophisticated, it's easy for them to rely on Upstart and all the data they have to essentially cut the loan underwriting process from like 3 to 4 weeks to 2 days. And these guys are essentially a funnel for smaller banks who don't have the time, manpower, expertise to underwrite loans faster. Now, essentially, at some point, this might become risky because they're underwriting to riskier and riskier borrowers. But at the time when you're recovering from a pandemic and all the tailwinds are behind you, this is a phenomenal trade, and this was a large cap trade. So it's not like I just focus on the mid caps. This is where I had an edge. And now we'll talk about kind of Ontario, and we'll talk about my views on inflation and what was going on in the energy patch.
Absolutely.
So in energy, we had underinvestment for over 5 years. So you guys probably remember 2015-16, China essentially imports 60% of the world's commodities, right? For iron ore, copper, coal, and believe it or not, oil. For OPEC, China, India are more important than the U.S. are. The U.S. and developed nations are. U.S. actually develops its own oil and natural gas, through horizontal shale, fracking. There are a number of pure plays that have emerged over the last 20 years. But the issue is that the oil that the U.S. produces is different from the oil produced in Saudi Arabia, right? And Venezuela. So our refineries in the U.S. are complex hydrocrackers that they make more money if they import, for example, Venezuelan oil that has high sulfur content, and then they make a fatter margin because they buy it cheaper, right? Because high sulfur content fuel is a lower cost. And what a refiner does, like a Valero, for example, is it takes that oil and it refines it into different petroleum products. And for example, every barrel of oil that might go through Valero might generate, for example, 1 barrel of distillates. Every three barrels might do 1 barrel of distillates, 2 barrels of gasoline, or maybe every 4 barrels will do 1 thing of jet fuel, 1 barrel of distillates, and 2 of gasoline. And what you make, the difference between what you make on the products versus the inputs is called the crack spread. And the U.S. can't be energy efficient right now because the oil we're producing isn't the oil that our 30, 40-year refineries are going to make money on. So we still have to import, but because the U.S. isn't growing, right, we don't have any household formation, people aren't really having kids, they haven't had kids, just like all developed nations in Europe. Mm-hmm. And because we're not, there's not a lot of immigration coming in anymore, we're not using more fuel, right? It just makes sense. It doesn't make sense for the U.S. We're not, starting manufacturing plants in a big way yet either. So all the demand, even though our infrastructure isn't there for our refineries to refine our own fuel, the demand from us, from other parts of the world is very steady. But in areas, in the rest of the world where the middle class is rising and they're all buying homes and cars, there's a lot more demand coming from emerging markets. So that kind of sets the stage for, okay, what's been going on in the U.S. So whenever the U.S. produces, U.S. oil companies, natural gas companies had different incentives than was apparent in the media. So, from 2006 onwards, independent oil and natural gas companies, their goal was to produce as much friggin' gas and oil as possible. They didn't care about anything else. Investors who gave them money in the form of loans and equity, they only looked at their production, their PV10, which is essentially the net present value of how much they can produce over 10 years based on their reserve base. And they would do essentially multiples on how much BCF per day or barrels per day a company could produce. A barrel, in the case of oil, BCF, billion cubic feet, or MCF, 1,000 cubic feet in the case of a natural gas company. And natural gas, methane, is also a byproduct of drilling for oil. We'll get into that in a minute. So what we had is drilling going up dramatically for years and years and years without any capital discipline. What does that capital discipline mean? It means that most independent oil and gas producers, like a Pioneer, for example, or Sandridge, RRC, they didn't generate free cash flow. So if you're a company that is not growing at 50% a year, it's not a tech company, right? It's not an emerging technology. You need to justify to your investors that you can generate free cash flow to either buy back stock, pay dividends, or reallocate into PP&E, property, plant, and equipment, to grow your business. If you're not generating free cash flow, it's essentially a Ponzi scheme, right? If you're just growing and you're just burning cash, you're just taking more money from your investors every year. And that kind of hit ahead in 2015 and 2016 when investors realized that these companies are never going to generate free cash flow because all their models, when oil went to 1560, they realized, okay, well, actually oil went to 35 after the China scare, when China was having a recession and all commodities started selling off, that oil can, if our revenue is cut in half, these guys generating X number of BCF or barrels a day, they're going to need twice as much cash from us because they're not generating any cash, and now even their revenues are lower. So this is, people realized it was a Ponzi, essentially. I'm trying to simplify it.
Right.
And about 30 or 40 oil companies went bankrupt, right? And, since then, we've had a bunch of oil busts and booms because OPEC has decided with Russia to release and increase production every year to a certain extent. And the market's gotten so sick of oil companies, and that combined with ESG, that there's not a lot of money going into energy these days, right? You're seeing that all over the world. You're seeing even like the pensions in Scandinavia, right? The big underwater oil producers, even their own pensions are not allocating money to new oil businesses.
Right.
And you're seeing the big oil majors like BP, Chevron, Exxon trying to invest more in renewables as well. Because pension funds, endowments, like university and governments, they don't want to pay or invest in things that are not ESG. So you have two things. You have the fact that these companies didn't generate cash, and hedge fund investors, insurance companies are pissed. But then all the ESG investors, they don't want to touch tobacco or animal testing or oil. So because of that, you can look at something called the rig count. So I'm going to pull up. The Baker Hughes provides a rig count, and it's free. I provide this. You can actually get it online, but it's quick to pull it up here. On Bloomberg, this rig count shows you essentially how many rigs, are operating. You kind of see that the operating rig counts, because of just mass mandates, the economy shutting down, less miles driven, hit 185 for oil. And we're down over 80%. And if you look at gas, you can see that the rig counts haven't really increased. Go to the 5-year. They fell at about 70%, and they've kind of flatlined. They've actually come down, whereas oil has been going up. Right. In gas, you're seeing even a bigger issue. Now the rigs have been more efficient, so they're getting more out per rig. But the fact that rig counts are actually coming down shows two things. One, there's a lack of labor. There's labor scarcity. A lot of the guys who are working in oil have found it easier to make money going into construction because the real estate boom, millennials moving from cities to suburbs, big demand for labor, and also 3 million people retired early. A lot of those were service people. They were truckers, they were plumbers, electricians, people who didn't have mentees. Younger people didn't think it was cool to be an electrician or plumber. Well, guess what? Now you can make 150K as an electrician because we don't have any, right? Same thing in energy. A lot of these energy guys who are used to making 120K, when they got laid off in 2016 through 2018, they're like, I'm not going back to energy. I'm going back, now real estate's booming. I'm going to go there. I can take some of the money I'm making. I can flip my own homes. I can do my own thing. I don't have to be restricted on this rig. I have more flexibility, more time with my family. So with these rigs, sometimes you're away from your family as well for months.
Of course, yeah.
So you have people who don't want to work, at these companies, they view them as like kind of dying companies, right? Because of EVs and because of renewable energy. They're people are wondering 10 years down the line, if I'm in the energy sector, is this going to work for me? Should I be doing something else? And we have early retirements. On top of that, you have just companies are more capital disciplined. They know that if we have another crisis, there's no hedge fund or insurance company or mutual fund that's going to give them any money. So what they're doing is they're conserving more of their cash instead of spending it on new rigs, because it's very capital intensive, right? To set up a new well, they're saying let's monetize all our own wells with what we have, and that's created a supply and demand imbalance, and it's worse in Europe to the point where you can see with gas in Europe. You were looking at the front month UK gas futures have gone completely parabolic because the situation is worse in Europe because they rely more on Russia. And the equivalent, look at this crazy spike.
That's crazy.
You're going to see people with like $4,000 a month heating bills.
Right.
And that's why, the Dutch are subsidizing a few $100s now, bills. But I can tell you, my mom's in the Midwest. She just started turning her heating on now. Her heating bills are twice as high as they were last year.
Wow.
We've gone, this 220 is the equivalent of $30 per MMBTU. So that's 1,000 British thermal units is how you can convert into energy per energy terms. So that is almost 10 times what we pay for gas in the U.S. Right. So if you look at U.S. natural gas, which has been trading in sympathy with European natural gas. Now I've kind of painted you a story. I saw this happening from the summer because I saw the rig counts were actually starting to go down versus up, and I was like, this doesn't make any sense. So the fundamental U.S. price for gas is around $4.50, but because of the U.S., because of what's going on in Europe, and because we export through our LNG terminals, we take gas that we make in the U.S. We have a very large reserve in the Marcellus and Utica shale. You can take that gas, liquefy it into freeze it into and cool it into a liquid form, put it on a vessel, because when you freeze it, you have a lot more density per cubic feet. You freeze it, you send it overseas. That's the liquefied natural gas business. We're selling 12 billion BCF a day of the 94 we generate to Europe and Asia. So whereas there's no connect with Asia and Europe before, the U.S. market is starting to trade a little bit more in sympathy with what's going on overseas. And for that reason, I shared with a lot of the guys who followed me earlier in the year to go long names like on Terra Resources that has less natural gas hedges, because when companies produce, they hedge some of their production. And I know that some of the stuff I'm saying is complicated, but over time, guys who are with me, I tend to explain these things in a lot more detail. And I know we have limited time today, but and I want to get to a couple more topics.
Yeah,
but on Terra Resources, Sandridge, Range Resources are names that were not sexy names. They're not names that people are talking about, but they're all 2.5 to 3 baggers. And the reason why is, people didn't understand that we were if we have a cold winter, we can be in an energy deficit in the United States. And I've actually started trimming these because, weather is unpredictable and the run-up is unbelievable. So I've actually started trimming all these names, but these were names that, using fundamental research and common sense, you could have made money outside of memes and OTC and all the big growth names, or even FANG that everyone pitches online.
Right.
So another area that I focus on is spin-offs. So spin-offs are a form of a special situation where a company is spinning off a business from a larger whole. So, L Brands was a combination of Bath and Body Works and Victoria's Secret. Victoria's Secret had underperformed for many years because it was targeting a specific size of a woman. It never increased kind of big, in the United States, 70% of people are overweight. They never targeted, slightly fuller bodied women, which was a very bad strategic decision for them. So, in fact, my girlfriend actually is a trainer, and she trained a lot of the Victoria's Secret angels, and they were even complaining about, harassment and, management not being in tune with, they're not as woke as they should be. So, they had a lot of internal issues, but the company was trading at like 3 times cash flow. Victoria's Secret was trading cheaper than a coal company or a company that had gone bankrupt. And if you built a model and you saw where Bed Bath and Body Works, essentially candle maker, fragrance maker, home goods maker, should have traded based on a comps analysis. And I'll show you a model so you can see what I'm talking about. The stub, the remaining company of L Brands, which was Victoria's Secret, which came out, in the 30s originally, you could have bought at a very cheap multiple to cash. So, this is a very quick trade. It was a 2-3 week trade where you could have doubled, taking very little risk, by essentially buying the Victoria's Secret stub coming out of the L Brand spinoff. So that's something unique that that I was able to monetize and have no exposure now. Given the energy theme we're talking about, uranium was something that I started spending time on after I spoke with the head of Real Vision, and I also did my own work on natural gas, and realized that because coal was the primary driver of energy, baseload power. So I don't want to spend a lot of time on power because I want to leave the last 5-10 minutes for SPACs, which has been a huge source of my alpha recently. Mm-hmm. But baseload power.
Did we lose you? But you're chopping up a little bit with your voice. Hang on, I think that's better.
I'm sorry.
Hold on a sec. Oh no, it's the market makers. I'm losing you. I'm losing you. Did we lose him? Oh no! What happened? Oh, he says 1 second. He just DM'd me. Are you back?
Yeah.
Try saying something again. Testing.
Testing.
Okay, I think you're back. The market makers took you down for a minute.
Man, it all took me, man. I was worried for. No. So just going back. So baseload power, right? Coal companies were, think about it, most of our grid. And when you look at a coal plant can operate essentially 24/7. With gas, now most of our power comes from wind and other renewables, gas, hydro, and a little bit of nuclear. Our nuclear plants are really, really old, and they go down for maintenance for long periods of time. And you know what's happened with wind last winter in Texas. There's no wind power,
right.
And people are paying $10,000 for their heating bills. And that's what happens when you rely too much on renewables that depend on the weather. Same with solar. And we saw the same thing with Germany. Germany is now 70% of their grid in the summers is wind. All these ESG investors, it surprises me how they don't have any common sense. Like, wind and solar can work if you have battery storage. It'll take us 10 years to build enough batteries to store the power. But if you don't have any storage, and all of a sudden you don't have wind, what's going to happen? Right? There are people that froze to death in Texas, and I'm really surprised that, there's other clean forms of power, whether it's geothermal or nuclear. The nuclear tech we're using now is 40 to 50 years old. A number of guys, Bill Gates being one of them, that have developed new forms of nuclear plants that are much safer, where the cores are much deeper in the ground, where there are much easier ways to dispose of the nuclear waste after the core has been spent. I started doing work and realized that they're all over the world, places like India, they're actually exploring nuclear technology. They're looking to build nuclear plants because their population is growing, they need power. And you're seeing, Indians are going to have a really tough time this winter. China is having trouble right now. Their coal prices have tripled because everyone knows if you have a cold winter, there's not enough power right now. So uranium, the Uranium Spot Trust owns a third of all uranium supply produced per year. Uranium is right now around $37 to $40 per pound. If you think about commodities are always operating off marginal cost of production. So a mine will only produce when it can pay its marginal costs. Most of the mines in the uranium space are in the money at about $60 a pound. So at $10 we were even cheaper, but I started loading between 10 and 12. And this trust, has about 40% upside to marginal cost of production if you start seeing companies actually buying uranium. They're Japanese nuclear plants that are restarting now because they don't have enough liquefied natural gas and coal. After the nuclear disaster in 2011 Japan, you had European and Japanese nuclear reactors buying less uranium and going offline. That whole trend is reversing now that fossil fuels are so expensive and people realize that you can't use renewables for your baseload power all the time. And the interesting thing about this is because uranium is such a small market, if the spot trust continues to grow, there's a chance you can have a squeeze because at some point they might own half of all the uranium produced per year. So it's a more speculative position. That's something that was unique in the way that and I know that we talked about it as well. But now I just want to take a quick break and talk about valuation. So, on special situations, everything I'm talking about, the reason I can get so detailed in my thoughts is because I'm able to quantify all my thoughts and view trends in models. And, just because you have a model doesn't mean you're going to be right. Or, I never post price targets. I always post ranges because as an investor, you own a part of a business. That business doesn't have a price target. You're looking for that business to be operated well, and based on the cash flows and the future revenues and gross profits and EBIT of that business should have a value. And you can only understand that value if you know what the inputs are, like what the business is taking in, what it's selling on the other side. So really easy example is a bank, right? How does a bank make money? How do you model a bank? So with a bank, you have three forms of revenue. You have a net interest margin, right? Where is the bank borrowing its own money and where it's lending out to customers? That they make a spread. And banks tend to borrow in the short-term markets, right? Like commercial paper, swaps, and they lend in the long-term market, right? They'll lend you a mortgage, right, at 3-4%. So they're borrowing at like 50 basis points to 1%, and they're lending out at 3. They make that 2. They take advantage of the yield curve, right? So if you understand how the yield curve is shaped, you understand why banks have been earning less on the NIM side recently, okay? The second way that banks make money is through fees. Fees for investment banking services, fees, your overdraft fees, fees for starting an account. That is, how they pay for their infrastructure. And that's why you have no infrastructure banks that charge no fees now that are growing. We'll talk about that later, like SoFi, etc. But then the third way that a bank makes money is through proprietary trading and investing in securities, right? So if you understand those three ways that banks make money, so you can model each form of revenue in a tab, of a model and aggregate those together to create, your own estimate for a company's EPS. And when you put a multiple on that EPS, you get a stock price. So you can do that with companies like Disney. Now Disney is very complicated because I've modeled out ESPN, Disney Channel, Freeform, National Geographic, and all these models, I give to my subscribers for free, so you don't have to do all the work. Right. And all of the inputs, they're all coming from public financials. So all of this is just hours and hours of work, but if you do the work and you sensitize your assumptions, you can call investor relations and talk to management and see how they're thinking about it, and you can essentially bounce your ideas of how they model internally as well. You can come, for example, to your own conclusions. So, now we're looking at multiples. I give a number of examples where you can do peer analysis, right? You can value a company on a discounted cash flow, right? Which is essentially taking the future cash flows for each of their businesses and coming to an enterprise value, right? So here I take ESPN, for example. I take their cash flow, or EBITDA, earnings before interest, taxes, depreciation, and amortization. I subtract out their depreciation to get EBITDA, take out the taxes, get EPS, and then I add back, this is tax affected, add the D&A back, this is a non-cash charge, take out the money that they're spending on their CapEx to get what we call a free cash. Because the earnings you see on, within the media and Wall Street, earnings mean nothing. There's so many adjustments in there. Right. If you want to understand what a company's worth, you have to look at free cash flow. You take that free cash flow and you assume a discount rate on that cash flow or a multiple for that cash flow, and that's how you compare companies to one another. I'll have another session on how these models work, but essentially all these models are driven by inputs, right? They're driven by revenues, they're driven by operating expenses, and each of the revenue models and operating expenses are driven by line items, right? So linear affiliate revenues for Disney, direct-to-consumer revenues, their new direct-to-consumer product, Disney Plus. And the interesting thing, I think my screen might be a little frozen, hold on, is that I also provide scenarios. So I provide usually 3 or 4 scenarios. So if you look at my Palantir model or my Tesla model, it has like 5 scenarios. I provide scenarios for different revenues. So here I have bull base bear. For Tesla I have, okay, for the next 5 years, what if they produce X units of cars, or they introduce autonomous driving? What you can do in the models is you can change the different scenarios to see how that can impact the stock price, right? So that all rolls up. Each one of these subsidiaries will roll up to the sum of the parts, and then what you get is a range, depending on which scenario you pick, a range of prices, right, and potential upside. So I think that the models have been really helpful, and they take some time to understand, but once you understand how they work, it can be really beneficial to individuals. And finally, if we have a couple minutes, let's just talk about SPACs. So SPACs are a form of, I've never seen something that is this easy to generate alpha from since 2012, 13, 14, when we were talking about REIT conversions and MLP conversions and tax arbitrage. There are about 600 SPACs outstanding, and we cover all of them just to one level over the other. Some we don't have full models on, okay, but we cover them in forms of the SEC filings, when their pipes are going to come out, the underlying business models, and we rank SPACs from 1 through 5 based on quality scores, their management team, who the underwriter is, when the revenues are coming in, whether the technology is realistic or not. And so we track all the pre-deal SPACs so that you can generate a yield, because if you put your money in a bank, you're making 0.1%. We cover SPACs where you can one, generate a yield of close to 2% that you buy below trust. I also cover cheap warrants, so about 380 warrants from 20 cents onwards. Warrants are essentially less volatile than stock options, because essentially with SPACs, if you buy a pre-deal warrant and the deal is announced, the implied vol when you're buying a warrant pre-deal is like 15, right? Most of the options that I see FinTwit buying, their implied volatility, if you understand the option Greeks, is around 100, basically 60 to 150, because there's so much excitement about these stocks. You're overpaying when it comes to premium, and it tends to be harder to make money, and you're paying premium for shorter periods of time. You're paying premium for a week, you're paying premium for a month, you're paying premium for 3 months. I'm not saying that's bad. If you do it the right way, with call spreads, put spreads, you can do butterflies, you can do iron condors, but with warrants, I think you can find asymmetric opportunities where you can buy a pre-announced warrant at 20 cents that could go to $1 or $2 without even much going on in the underlying, because vol is increasing, and now there's a company out there, and I own DWAC warrants, right? I'm not saying that was an easy trade, but I own a small percentage of all these warrants,
right?
And I added on Monday, and I sold those warrants up like 600-700%. Wish I held them longer, but I thought I made an awesome return. But those warrants went up 5,000%, right? Wow. And you can only really uncover those, right, if you have a full database and you're tracking these daily. So I have every 2 days they come out with an update to my database. I have all the deals that were terminated. I have SPAC rankings of quality ranks, companies that are fundamentally cheap. I have my and this is what people love, my S1 pipe unlock, and it shows you, for example, what the relative float change is going to be, versus the redemption shares, and all the other shares, to show you like what the impact is on the float. And you can see that, since Lucid, right, on that day, and then Joby and Re and ATIP. I'm going to zoom out a little bit. This is a really easy way, I use to hedge my portfolio. Names that are down 25, 31, 18, 10, and all of these, like, you can just look, right? If you got this tracker and you saw what happened when the S1 came out, and we have estimates as to, how many days it's going to take for, by looking at hundreds of these filings, when the S1 is going to become effective, you can see how much these are down, whether you're buying puts or shorting outright. You could hedge your long SPAC book. So when people were down in September, on growth and de-SPACs not performing well, I was crushing it on my de-SPAC shorts because their floats were going up. One, you have a situation in SPACs where there are about 50 SPACs. I even have SPAC earnings here. There are about 50 SPACs out of the 600 that beat earnings, right? So why is that? SPACs tend to overpromise to individual investors because they want to get the deal done because they need the votes.
Right.
So these SPAC sponsors tend to be, some of them tend to be scummy. So I also have a tab where I rank all the SPAC sponsors, but some of them tend to be scummy. They partner with companies that aren't mature enough to IPO, and they're telling these companies, because SPAC sponsors get 15% to 25% of the company in the form of promote versus 3 to 7% for a company to IPO. So they're getting a lot of shares and warrants in these companies, and they're telling these companies, listen, if you tell this, the street, and SPACs follow merger law, they don't follow securities law, so they're allowed to give 5-year forecasts. And if they go out and tell people, oh, this company is going to 5x its revenues, you don't have to be right? With securities law, there's more of a onus to be correct and within a range. With merger law, you can say, oh yeah, well, our assumptions change. And you saw that with ATIP, right? It's trading at what, like $3 a share? They brought down their guidance like 4 times. Complete scumbags, right? And it's not like a complicated business. It's not like an EV or rocket business. It's fucking physical therapy. So how could you be that wrong with a physical therapy business?
Right.
So we rank all, we do rankings and we track earnings on everything as well. And what we found is that, try to move this, when you have these redemptions started in the second half of this year, and you can see how high some of these redemptions are per deal, right? LWAC EFTR was a 97% redemption because investors are now scared. They own these SPACs at trust. They know they can get the $10 back in the trust. If these guys are lying to us, why are we going to give them the capital post the merger date? So we saw the dynamic for the first time in SPAC history, where you see more than 60% of the entire de-SPAC universe of being redeemed, and that's taking money out of the SPAC world. At the same time, these PIPE investors who are hedge funds that have gotten in because they've gotten extra warrants and shares that, by the way, they don't tell you in the filings. You have to figure it out on your own. They're in at $8.50 to $9, right? Versus what they're saying, they're in at 10. They want to lock in their gains between 8.50, 9, and 10. So these hedge funds, when you're looking through a PIPE, you want to see what percentage are long-term investors, what percentage are PIPE investors. So I track all of that. And when you have a high redemption, we'll go back to the S1 tab, and your float then increases. So when your float decreases because you have high redemption, then all of a sudden, right, with Joby, you have a high redemption, and then your float goes up. Your float increase as a percentage of float when the PIPE shares convert is 300%. Wow. Obviously, the stock is going to be down 10, 15, 20% at the open. So this is why a lot of guys have started to use my service. In fact, most of like the big SPAC guys that you see on Twitter use my service because I provide kind of the most detail on SPAC Catalyst. That's what my service is called for SPACs. And it's been a great way to generate alpha. And then I also have my low float tab, which tracks the number of gamma squeezes. I have essentially short interest. So I subscribe to Black Box, which you have to pay for, which provides S3 data.
Yep.
So essentially, I have up-to-date short interest data. I also provide links to all the company presentations.
Oh no, I think we lost you again. If you can hear me, Jay, your mic is not getting picked up again. This program is too powerful. It's too powerful. Let me send him a message here. He said it might be his internet. Now they cut him off for mentioning Black Box. I've seen that Shib just got knifed. And you guys think there's profit taking or that Elon killed it? Interesting. I can't hear you yet, Jay. Not yet. Sorry, guys. We're just trying to get him back on here. He's going to try to re-enter the call.
Yeah.
Hello?
Hey, can you hear me now? I re-entered the call.
Yep. Sounds good. Sounds good.
I'm going to try to wrap it up. I think, Discord's probably mad that I'm taking up so much of their bandwidth. So I wanted to leave it, open to a couple questions. I know I've been droning on and on. There's an insane amount of data I threw at everyone. But, the simplified version of this is my goal is to provide education to individuals and across various asset classes so you can have a diversified portfolio of different factor exposures. And I tend to cover things that a lot of people aren't, which I think makes me a little bit different than what you see on FinTwit. But, I've been doing this for many years, and I'm loving to see that they're more sophisticated individual investors now than there ever were before.
Yep.
Yeah, and I'm happy, for the time that, I was able to share with you guys.
Absolutely, man. This was literally insane. So, me for myself, I'm almost a purely technical analysis trader, and then yesterday we had on a purely options flow trader, and now to have you on and have all this fundamentals and kind of investment trading is super interesting, dude. You blew my mind
for
today.
Sure.
So it's cool to see.
No, and I'm so happy to share it because what we've seen is there's so much. The Federal Reserve has put in so much capital into the economy, along with the fact that we had fiscal stimulus in the form of checks coming directly to people. We had, moratoriums on paying student loans. We had eviction and rent moratoriums, and then we had PPP money going to large individual investors who never paid it back and never hired people. So we had so much money in the economy, and that's not sustainable, right? So it's important to have technicals are important. I use price volume volatility. Options flow is valuable, but if you're able to combine those with fundamentals, you can perform well when markets are down, and when markets are up, and you're not worried about one trade. If you have different ways to make money, and the one way you're making money isn't working anymore, you can still sleep well at night. So that's kind of how I think about investing, and I do think 2022 is probably going to be the most difficult year in investing that we've seen in 3 years because the Fed's going to be taking out, it's going to be stopping its quantitative buying, quantitative easing, buying of bond securities. It's buying $180 billion of securities a month, which is forcing institutions to take more risky investments, which is providing uplift, right, to the stock market. You have, the eviction moratorium's gone, and you have a situation where people don't have to pay their student loans again, and you have inflation, right? So when you go to Costco, they might not jack up prices on your cereal box by 20%, but actually instead of 16 ounces, it's now 12 ounces.
Yeah,
so there's inflation, right? There's inflation that we can't even see. These companies are smart about it, but the purchasing power of your dollars is going to decline, so you're going to have to be more creative. A lot of these companies are not going to be able to generate the margins that they once were able to do as well. So I think we hit peak margins this year. So 2022 could be really interesting because just buying calls isn't going to be an easy way to generate alpha.
Gotcha. No, that's great, man. And so where does somebody, I have your Twitter pulled up. Is this how they can access your service, and how much is that going for right now?
So it's specialsitsresearch.com. I think on my Twitter, it's at the top. There's an image at the top.
Yeah.
But once you go to the website, I've tried to make it very inexpensive for individual investors. So I put out free macro calendars, earnings calendars. The basic service is $15, and you get essentially all the free calendars. You get screeners. You get models. You don't get the whole model database, but you get models, on a weekly, monthly basis on companies that are interesting in the market. You get, you'll get one write-up on an interesting name. And then if you're focused on SPACs and you're one of these hardcore SPAC traders, or you just want to learn about how to generate alpha, there's a $45 service that focuses on SPACs. Okay. If you want the entire model database of all the companies we cover, there's a silver subscription for $45. There's a gold subscription that focuses on that. Essentially, it's $100 a month, but we talk one-on-one once a month for 30 minutes, and we can dig into any one of the companies that you want more information on, any strategy that you want to learn about in more detail, whether it's options or special situations or REITs or MLPs or SPACs, which I think a lot of people have liked and have been signing up for because they like that one-on-one interaction.
Well, that's great.
So there are a number of different things that we offer. I actually have hired 2 analysts part-time who help build the database because it's just a lot of work for one person to do.
Of course, yeah.
So that's it. I think what I provide is a very unique product.
I haven't seen anything
I don't think
like
there's really anything like it.
No.
Yeah.
I completely agree. And so before someone signs up for this, or maybe this is fine, do you recommend a trader like myself, for example? I don't deal a lot with fundamentals. If I was going to sign up for this, do you recommend I kind of go through and learn on my own for a little bit, or is this kind of like from nothing and you build us up?
Yeah, so it is. I do kind of build everyone up.
Okay.
It depends on. You do need some investing background. You need to have traded before. You need to understand, limit orders and all the basics.
Of course, yeah.
You need to understand, what a company is, how it makes money, how, what an IPO is. But what I do is I provide books, to all the subscribers that, over the first 2 or 3 months, you can read these books, The Intelligent Investor by Benjamin Graham, Margin of Safety by Seth Klarman, which goes on the street for like $3,000 a pop. So sure, kind of like digital copies of all this stuff so you can learn the basics on your own time. And then once you start seeing the alerts and the data, you can put, 2 and 2 together. So it's something that you build over time. Like I didn't become good at this, overnight. It takes years
Right, of course.
to do well. So, the goal is that, over, a certain period of time that you guys, can learn all this, become independent, and, invest and allocate on your own. So the focus is really education. So we do provide that educational material. We also have a modeling class, which is on the website. I think it's like the last model in the model shop, which is a 4-week class, 3.5 hours a day, once a week, that actually teaches you how to build a model from scratch.
Wow, that is super, super cool, man. Damn.
Yep.
And so this is a purely educational service, or do you guys also have an alert system?
We also have an alert system.
Okay.
Our SPAC Catalyst product has been our most popular product because we send out, every 2 days, we send out, the full database, 600 SPACs, and we point out, which names are potentially seeing pipe unlocks. And we also point out names that have very low floats that could be runners. And then, we publish models which are essentially alerts, for REITs, for companies like Disney, for large caps, mid caps. Across the gamut, we published a report on SoFi when it was in the teens, when people didn't understand the business model, and that went out to all subscribers, no matter what tier you were. So there are, we never say buy or sell. What we do is we provide you, this is a range of valuations. If that range of valuations is 30-40% higher, you can tell what our view is. But because we're not a licensed broker, we don't actually provide. We're very careful when it comes to compliance.
Of course,
everything we do is by the book, so we don't actually say buy this option or buy this strike.
Right.
At some point, that's not going to be allowed, and we want to be ahead of that.
Right. Got you. So I kind of asked this with all the interviews as well. We can't give advice and stuff like that because of the licensing and the legal reasons. But let's say for yourself, if this was happening to you, if you were having red day after red day, let's say you're a small account, you got a few $1,000s and you're having some red days after red day, you're reloading. How do you kind of get out of that mindset? And what are some rules that you would give yourself kind of trading with a small account? Did I lose you? Oh no, I might have lost him again. F's in the chat. No. Everyone in chat's like, no, that's what I wanted to know. Oh, I heard something. I think you're coming back.
Hold on. All right, now?
Yeah, you sound good now. Okay, did you get the question?
I did get the question.
Okay. Okay.
It's important. I can tell you from my experience, right? At college, there are all the finance boards. You guys from Yahoo Finance, where they're all tech stock, and there's similar there is in stock to what it is today, and there's a bunch of FUD and a bunch of people pumping, and I was. When I was in college, I was buying small caps, I was buying pennies, I was buying futures and trying to trade, all these crazy things. And I realized that it was without knowing what you're doing, you lose money really easily. So a couple rules are: I never have 10% of my account in more than one trade. I never have 10% of my account in one trade unless it is a very asymmetric upside, where it's like a NAV spec that I'm buying at 10, there's 10% cash, and I know that it can go up dramatically, and the downside is 1 or 2%, right? Like Supergroup, SCAH last week, right? You could have bought that at 10.10, right? And that's 1% downside on 10. And AGC, you could have bought, over the last month, you could have bought it at 10.05, 10.10, 10.15. It ran to 11.14. I put 10 million in that, made 1.4 million, knowing that I could only lose a few grand. Right. Because of my cost basis. So unless I can size something and I know it's extremely cheap, I'm not putting more than 10% of my portfolio in one trade. I'm also putting limit orders on names that I'm less comfortable about. So when you have kind of the names that are compounding, they're up 20, 30, 40% in a week, I'm putting trailing limits on those, trailing stops on those. So I use limit orders to buy, and I put trailing stops. What else? I tend to diversify my portfolio into multiple factor exposures. So, I always have like core REITs that pay me cash flow. So they pay me dividends of 7-8%. I have a core part of my portfolio that's always in cash, because I wouldn't have had capital to buy DWAC or AGC if I didn't have cash. So I always have 25 to 35% cash available. And I always so when I go to bed at night, I always monitor what exposures I have to every sector. So I have these natural gas, energy, uranium names. I'm going to cap that at 25. I have my real estate names. I'm going to cap that at 25. I have my SPACs, right? I cap those at 25, and the rest I have in cash. So right now I have 3 buckets, and I had most of my portfolio allocated to tech growth and special situations. And I've rotated that, and I'll rotate it again. But when I go to bed at night, I have an up down on every position. This is where I would sell out. This is where I would trim. This is where I would buy more. And so when I wake up at 4 in the morning, I'm looking at pre-market, and something happens, right? I know which position. I know what I own. First of all, I understand the businesses that I own, but I know where I'm comfortable trimming before the market even opens, and I know where I'm comfortable selling. And I think that's the most important thing. And I keep track of everything in a journal. So having a journal, and I handwrite my journal, keeping a journal and writing down, this is the mistake I made and why. Over time, you'll become better because you'll identify, oh, why did I get into this trade? I got into this trade because of FOMO. I got into this trade because XYZ Twitter account said to get in, but they didn't explain why. Or I got into this trade because of the space, or I got into this trade because of a Reddit thread, but I didn't really do any of my own work, and I'm not going to do this again. So keeping a journal and writing down the name of the company, the trade date, the valuation, why you got in, and then revisiting that every day is one part of my journal. The other part of my journal is identifying all the important calendar dates. So I know when every company is reporting earnings, and I know, whether they're reporting pre-market, during the day, or after market. I know when their earnings report is coming out and the call is starting. I know what banks cover each thing. So part of my services I provide, for LTs, for example, there are 40 banks that cover this name. I provide the names of all of the analysts and their recommendations and why and the targets, right? So I know how Wall Street's thinking about a company, so that when they report earnings, if it's different than what Wall Street reported, I know within an instant whether that's going to trade up or down when they report. And sometimes that can save you money when you're trying to trim a position, or after hours when you're trying to buy a position when the earnings call is going on. So, that's kind of a quick summary of
Gotcha.
Ways that I try to mitigate my own risk. And I also overwrite my portfolio with covered calls when the market's range bound. And you can generate 30-40%, and with my gold product, actually help people understand how to do it, what strikes to use, because covered calls, for example, in a name like AVPT that hasn't moved at all during the year, you could have lowered your cost basis from $10 a share to $6 a share by selling covered calls for the entire year. And people don't really understand how powerful that is, because you're generating a synthetic dividend cash to your account.
Right.
So if you're holding a position for more than 3 months, you could sell 3 monthly call contracts, right, to lower your cost basis. And if it doesn't play out, well, you made that premium and lowered your cost basis. You can sell out still at a profit.
Interesting. Man, it's too bad we're getting close to time here. I would love to do I would love to do another video with you where we break down options and get into options trading.
Oh, absolutely. Yeah. I spent a lot of time doing that for myself, and it's a way to enhance your portfolio return.
Yeah, and I think it's especially a really useful tool if you do have a small account. You're starting with a couple grand and, paying rent and all this stuff. It'll really help, it can help you increase your portfolio a little quicker.
Yeah, absolutely.
Yeah, so I'd love to get into that. Maybe we can plan another date for that. Maybe next weekend or after the market close one of these days throughout the week would be pretty cool.
Yeah, absolutely. So I'm actually going to be at a wedding this coming weekend, so I'm going to be out of town. But definitely over the next couple weeks, maybe after the close or on another weekend, we can do it.
Yeah, for sure. I have I have some trader interviews over the next couple weeks, but I'm free Monday to Friday in the evenings. So let's plan something for that. That would be really, really interesting, I think, especially for me, because I'm very interested in learning more about options and flow and all that kind of stuff.
All right, sounds great.
All right, cool. So yeah, once again, guys, I have special situations up on the screen. There's his Twitter. Please hit him with the follow. Check out the site if fundamentals and DD is right up your alley. This is what you want to sign up for, and it's actually pretty cheap. There's not a lot of paid services out there for us traders that are this affordable. So I highly recommend. You heard the man himself today. The guy knows his stuff. Okay, so please check it out. You will not regret it. Is there anything else that you'd like to end on, or shout out or promote? The floor is yours.
Absolutely. Thank you guys so much for your time. One, know what you own, manage your risk, and be disciplined. And I think if you can do those 3 things and you learn from your mistakes over time, I think you can generate wealth for you and your family over time. So wish you guys the best of luck, and hope you guys have a wonderful week next week.
Awesome. Thank you so much for coming on today, Jay. I really appreciate that. And we'll see you
Thanks,
very
100.
soon to do an options kind of rundown. That'll be really cool.
Absolutely. Talk to you soon, guys.
Okay, man. Talk to you soon. Later. Have a great rest of your weekend.
You too.
Bye-bye. All right, traders. That was Jay, a.k.a. Special Situations, out on Twitter. Please check him out. Hit him with that follow. The guy just spits knowledge, dude. What the hell? Are you kidding me? That's crazy. Like, bro. For me, like a purely technical trader, to listen to that, I'm like blown away. I knew like maybe one or two of those terms. I knew like long the stock. That's crazy, dude. I gotta rewatch this again for sure. Absolutely insane amount of knowledge. Please check out his course. You know, if especially if this is great too, if you're working a day job and you just don't have time to be doing that DD and that fundamental research. Okay, this will literally cut all the time out. You can just sit on your ass at night after your day job and just run through these spreadsheets and go, okay, I've just done, you know, 50 hours of research in about 10 minutes. Right? Crazy. Absolutely crazy. So guys, I think I'm going to wrap up the interview on that. As for streams for the rest of the week, I'll be live again tomorrow night. I do work tomorrow, doing an 8-hour shift. I'm going to try to get on live for maybe Power Hour for you guys. I'll be live in Power Hour and a little bit in the in after hours. Alrighty. So I just want to say thank you guys for joining me today. I hope you enjoyed the interview. It seemed like a lot to learn. Listen, the breakdown is pretty simple on his site. He walks you through it. Lots of great stuff. I know I could definitely benefit by checking that out. So please have a great rest of your Sunday. Let's make some money tomorrow in the market. I love and appreciate every single person in this community. And I stream every single day, providing you with the best content. That was intense. Yes, sir. All right, guys. I will see you tomorrow afternoon for some more live trading, live charting, and stock talk. Alrighty. Have a great evening, guys. I love you. 100 out.
keep on